Suddenly, the FI activity in India is rather negative at a time when India is doing much better than other markets, even in terms of performance. Why are FIs now aggressive sellers in a market like India, where the performance and the earnings now are showing signs of genuine outperformance? Excuse me.
First of all, the point to note is that FIIs have been sellers across Asia. This is not just an India-centric phenomenon. There have been sellers in China, there have been sellers in other North Asian markets like Korea and Taiwan, and even in Southeast Asia. So it has to be looked at in that perspective. And I think partly the reason is the concerns about the consequences of a renewed wave of COVID-19, especially in this part of the world where there's a degree of lack of vaccination, or the momentum is significantly lower than in the developed markets. Second, we're also noticing some concerns about the regulatory changes in China. So that's a China-centric issue, which, of course, is leading to some degree of enthusiasm about the non-China markets. I mean, we have seen that of late, pertaining to Korea, pertaining to Taiwan, pertaining to India as well. I think, on a relative basis, the FII's, point of view towards India should possibly improve slightly from here. They would also take into account the fact that, the recovery from the second wave of COVID, both in terms of the infection rates and in terms of the economic parameters, have actually been quite strong. In fact, these two were the reasons why we upgraded India back to an overweight just around, the late last week, around middle of last week, rather. It was basically these two considerations.
For those who are saying Indian markets are trading above their historical P multiple and it is the best performing emerging market, and the only other market which has done better than India this year is Saudi Arabia because of oil, how would you defend your overweight stance? Aren't you too late because valuations have already run up?
Valuations no doubt do appear expensive compared to the Asian peers. But I would also point out that in the whole of the Asian and the gamut of Asian markets, there are only three markets which are driving the earnings estimates upwards. And these are Korea, Taiwan, and India. So it's not surprising that foreign institutions' interest on a relative basis is actually focused on these three markets. Secondly, one also has to note that the sectors that are driving up the earnings estimates in these three markets are actually quite broad-based. We have seen possibly 4 or 5 different sectors in India, maybe 6 or 7 different sectors in Korea driving up these earnings estimates. So I think, what appears to be a relatively expensive valuation in an environment of rising earnings estimate might appear cheap tomorrow. So it's basically a dynamic decision-making framework that we have to appreciate.
Hi Manishi, this is Mabina as well joining me. It's interesting you say.
Sorry, I could.
Manishi, just. Yeah, I'll take on from here. It's a good start for the market today. But Manishi, one wonders what's happening to banks per se back home in India. Because, clearly given the large sector that it is, the large weightage that it has, and it's almost one of those flag bearer sectors here in India. What one has witnessed this time around, especially when it comes to some of the large private banking names, is that there is clearly an uptick in retail delinquencies. You can call it a one-off because of the second wave impact. But, the financials are looking a little bit shaky. You think there is a change of guard which is taking place, at least the stock prices seem to be reflecting so, wherein some of the large, compounders, erstwhile favorite private banks are taking a bit of a step back, and some of the large PSU banks are coming up along with some of the private corporate banks?
in the financial space, it could turn out this way, that there's a clear degree of differentiation when it comes to this question of retail delinquencies that you mentioned. We think that, despite the recent news flow, it's really the top quality, top rung private sector banks who would be relatively immune from this, partly because of the diversity in their loan portfolios and partly because of the systems and processes that they follow, which are superior compared to their peers. Within the NBFC, or the non-banking financial space, we think the second and third tier retail lenders could be at risk. So that's the space where investors need to be cautious. This problem could arise even in the public sector banking space. But again, I would make the point that the frontline or the top quality or the top leading banks would possibly be relatively immune from this. So in fact, we have increased our weight on India recently by adding to the financials, and in particular through the public sector banking universe. We still remain positive on a relative basis on the private sector banks. We still have a large allocation to that. But the incremental addition has come in through the public sector bank universe.
Manishi, one wonders as to how long the supercycle in metals is going to last, for instance, because as of this morning as well, upgrades continue to pour in. Sure enough, the demand-supply situation, the pricing scenario is favorable, but the fact of the matter is also that one has already seen a big rally play out in the entire metal sector, which has lasted us almost over a year already.
Metals, for now, in the near term, could take a breather as a consequence of, number one, there's a lot of government pressure in some pockets on the metals and mining companies, on other commodity companies, or also on, to curtail the degree of, I wouldn't exactly use the word collaboration, but the kind of in-step movement of prices that are affecting some markets. But at the same time, we must also remember that this demand-supply equation, there are two sides to it. Number one, demand has skyrocketed as a consequence of consumption demand and investment demand in the developed markets. The supply side has been curtailed for over the last several years. If one looks at the capex to sales of metal companies in the entire Asian region, and the Asian markets, the Asian economies were the primary, spenders, primary investors in these areas. You would notice that from double digits, from about 15 to 20% capex to sales, they have possibly declined to low single digits over the past 6 to 7 years. So these sectors are also largely underinvested. We're only seeing over the last couple of years that some sectors, like building materials, for example, there's a small uptick in some of the Asian markets in terms of capex to sales. So not only have demand moved up, supply has also been, at a very low ebb over the past several years, which is accentuating this demand-supply gap. And as we all know, that releasing supply, that creating additional supply, it can't really happen overnight. It takes time. So we think that the buoyant commodity prices, the buoyant metal and mining prices would be here to stay for some time. Stock prices may take a breather because a lot of expectations have got factored in. But the basic story is here to stay for now.
Hi Manishi, this is Mubina as well joining in. In the beginning you mentioned about how India is driving the earnings estimates upwards. But considering the fact that we are a commodity consuming country and we are seeing these sorts of inflationary pressures, you briefly alluded to it as well in your previous answer, don't you see it as a threat to earnings in the quarters going forward? And what are the sectors you see whose profits will be most vulnerable to this inflation?
For some sectors and for some companies within those sectors, it's definitely a threat. Particularly, I would focus on those companies which are unable to pass on these cost hikes to their customers, those companies which lack pricing power in the present market. If we notice the top rung leaders in both consumer discretionaries and consumer staples, they seem to have some degree of pricing power. And as a consequence, we think that they would be relatively immune from this margin pressure. But we have seen if one follows the commentary of the companies, both in staples, in consumer discretionaries, possibly more so in staples, there is a degree of margin pressure that most companies have talked about, and I think it's something that investors should take note of. Somewhat fortunately, these two sectors, along with let's say some of the other engineering or capital goods companies, they contribute somewhere around, about 20 to 25% of India's earnings. The commodities, metals, they contribute about 10 to 12%. And in general, as we know, that commodity prices can't really go up and sustain themselves at a high level without a global and local economic upturn taking place. And the sectors that are related, positively correlated to these local and global economies, like financials or like IT when it comes to the global economy, they also have significant contribution to the overall earnings pool. So on a net basis, we think that the consequence of this commodity price going up and the drivers to these commodity price going up are positive for India. And it's something that we're already beginning to see. The sectors that are driving up the earnings estimates are IT services, financials, metals and mining and energy, obviously. And some of the top rung companies in the consumer discretionaries and consumer staples, even though the earnings estimate movement in those two sectors are not uniform.
Okay. All right. Well, let's talk about IT then, since you've brought that about. We've seen a massive run-up. I think what you've been saying as well seems to already be acknowledged by investors, right from the big rung ones to the mid and the small cap ones as well. A massive run-up being witnessed. We are assured of top-line growth, at least that's if we go by the guidance given by these names. Do you see more firepower in these stocks, or do you think that all the positives have already been discounted at these multiples?
We do see more firepower, to quote your phrase. We are quite positive on the IT space, and we have a significant allocation to the India silo in our Asian model portfolio to IT. We are seeing new orders coming in. In fact, most of the top-rung large-cap IT companies are reporting a significant momentum as far as new order growth is concerned. We would also see potentially some, margin improvement as a consequence of the remote working practices that many of these companies have started adopting. And in fact, it's kind of an ongoing phenomenon for past 1.5 years, but it could actually become an entrenched practice for some of the companies. So, unequivocally, this is a space that we are positive on. Over the past few months, even the currency has provided a tailwind, and I think all these factors combine to make it a sector of choice for our Asian model portfolio.
So Manish, if somebody has to, let's say, create wealth in this environment, one side you've got Bitcoin, other side you've got a rally in the bond yield, equity markets at an all-time. How does one go about getting rich and creating wealth in this market?
Well, I'm not an expert on Bitcoin, and that's a space I would rather stay away from for now. But for the others, it's actually relatively easy to talk about. If you look at global equities, if one looks at the earnings yield versus bond yield, that question, then that question then becomes relatively easy to answer. Earnings yields and this would apply more so in the emerging markets, are possibly somewhere in the 6 to 8% range. Bond yields are significantly lower despite the recent increase in bond yields in much of emerging markets. So that equation, which over past 20 years has usually remained loaded in favor of bond yields, has actually reversed. I would also point out that in the context of the recent decline in the developed market bond yields, like in the United States, the 10-year bond yield has declined about 50 to 60 basis points. Some of the, some categories of equities in Asia, which are high dividend yield companies, they are becoming relatively more attractive. There are, real estate investment trusts in Singapore, in Hong Kong, which are obviously positively correlated to declining bond yield. So there are new avenues of investment also opening up as a consequence. So I think that this whole low yield environment that we have seen, that has created a phenomenon of equities becoming the only inflation hedge that investors could rely on a sustainable basis. And therefore, that driver of attractiveness of equities would possibly, it would possibly last for somewhat longer.
Sure. Okay, that's the take coming in right now. Manishi, while again the caseload in India and especially in states like Maharashtra and Kerala here back home have once again seen a bit of a spike coming in, the bigger question also is what happens to the reopened trade, your multiplexes, your aviation companies, QSR, hospitality, because the market definitely is giving them some premium right now as things tend to get better and vaccination count only gets an uptick. Is this a story which is of interest to you? Because even when it comes to earnings, some of the QSR companies have performed very well.
Yes. Potentially, yes. Because, as we vaccinate more and more, as we gradually engage in unlocking different parts of the country, obviously, these are the sectors which had been beaten down the most and therefore have the potential of maximum recovery going forward. Now, that said, there's always a risk of, what, many experts have called the third wave. One doesn't know whether that kind of a situation would materialize. But, I think governments and local authorities would always have to be on their guard to, prevent that kind of a situation. So, I think these companies which pertain to hospitality, QSR, it's something that we have to be slightly cautious about. And it's only when we have a significant degree of full vaccination, not just in India, but also in the region as a whole. That is when we would turn sustainably more positive on these companies. So that's why, while we have some of these exposures in North Asia, let's say in Hong Kong, China, we haven't really dipped our fingers into these, in these companies or these sectors in the Indian context.